Welcome to Lesson 3. Today, we embark on an exciting exploration of the different types of business activities that drive economies worldwide. Whether it's a service provider ensuring customer satisfaction, a manufacturer crafting products from raw materials, a wholesaler connecting businesses, or a retailer bringing goods directly to consumers, each business type plays a crucial role in commerce. By the end of this lesson, you'll have a deeper understanding of how businesses operate and what makes them financially successful. Let's dive in. A service business is an entity that provides intangible products, meaning it does not sell physical goods, but rather offers expertise, labor, or assistance for a fee. The revenue generated from these activities is called fee income. Examples of service businesses include plumbers, who provide services such as fixing leaks, installing pipes, and maintaining plumbing systems in residential and commercial properties. They charge customers based on the work done, materials used, and time spent on the job. Attorneys offer legal advice, draft legal documents, and represent clients in court. Their fee structures may include hourly rates, flat fees, or contingency fees based on case outcomes. Accountants assist individuals and businesses in managing their finances, preparing tax returns, and ensuring compliance with financial regulations. They charge fees for audits, consultations, and bookkeeping services. Architects design buildings and structures, ensuring they are functional, aesthetically pleasing, and compliant with regulations. Their income comes from project fees and consultation charges. Electricians install, maintain, and repair electrical systems in homes, offices, and factories. Fees vary depending on the complexity of the job and materials required. Computer repair technicians troubleshoot and repair software and hardware issues for individuals and businesses. Some may offer maintenance contracts or on-demand services. Service businesses thrive on expertise, customer trust, and reputation. Since they do not sell physical products, they often have lower startup costs, but require specialized skills or knowledge. Manufacturers are businesses that take raw materials and transform them into finished goods through a production process. These goods are then sold to wholesalers or retailers. Manufacturing businesses are essential because they create products that serve as the foundation of commerce and daily life. Examples of manufacturers include furniture manufacturers who take raw materials like wood, metal, and fabric to create chairs, tables, and sofas. The finished products are then sold to furniture stores or directly to consumers. Automobile manufacturers like Toyota and Ford assemble cars using parts such as engines, tires, and seats, which are often sourced from other suppliers. Food processing companies like Nestle and Coca-Cola take raw ingredients, sugar, cocoa, milk, and turn them into packaged food and beverages for mass consumption. Textile industries produce fabric, clothing, and accessories from cotton, wool, or synthetic fibers. Manufacturing businesses typically require significant investment in machinery, skilled labor, and production facilities. Financial accounting for manufacturers involves tracking raw material costs, labor expenses, overhead costs, and inventory management. Wholesalers act as intermediaries between manufacturers and retailers. They purchase goods in large quantities from manufacturers and sell them in smaller bulk quantities to retailers or, in some cases, directly to consumers. Characteristics of wholesalers include buying in bulk at discounted rates, storing large quantities of inventory in warehouses, selling goods to businesses rather than individual consumers, and often providing delivery services to retailers. Examples of wholesalers include grocery wholesalers like Sysco, who buy food products in bulk and distribute them to restaurants, supermarkets, and convenience stores. Electronics wholesalers purchase gadgets like smartphones, laptops, and televisions from manufacturers and sell them to retail stores. Clothing wholesalers buy clothing and fashion accessories from factories and sell them to retailers such as boutique owners and department stores. Wholesalers play a vital role in the supply chain, ensuring goods reach retailers efficiently and in the right quantities. Accounting for wholesalers includes managing bulk purchases, warehouse expenses, and distribution costs. Retailers sell goods directly to the general public. They obtain products from wholesalers or manufacturers and apply a markup to determine the final selling price. Functions of retailers include making products accessible, offering credit facilities, understanding customer preferences, selling in smaller quantities, and promoting new products. Types of retailers include supermarkets, like Walmart and Tesco, which sell a variety of consumer goods, including groceries, household items, and clothing. Specialty stores, like Nike and Apple Store, which focus on specific products like footwear, electronics, or cosmetics. Online retailers, like Amazon and Alibaba, which offer products via e-commerce platforms, enabling global sales, and convenience stores like 7-Eleven and Circle K, which sell everyday essentials in smaller, more accessible locations. Retail businesses must carefully manage inventory, customer relations, and sales strategies. Accounting for retailers involves tracking sales revenue, inventory turnover, and cost of goods sold. Starting a business requires careful planning and analysis. Entrepreneurs should evaluate several critical factors before launching their ventures. Choosing the right type of business activity involves identifying market demand for a product or service, conducting a SWOT analysis, strengths, weaknesses, opportunities, threats, and assessing risk factors and potential profitability. Selecting the business entity type includes deciding between sole proprietorship, partnership, or corporation, and considering taxation, liability, and control of the business. Choosing a suitable location requires evaluating accessibility to customers and suppliers, transportation costs and infrastructure, and availability of skilled labor. Capital requirements involve determining the initial investment in assets, equipment, premises, inventory, working capital for daily expenses and employee wages, and budgeting for future revenue and costs. Understanding the different types of business activities is fundamental in financial accounting. Service businesses, manufacturers, wholesalers, and retailers each operate uniquely, but are interconnected in the overall economic system. Entrepreneurs must carefully consider their business type, location, and financial planning to ensure long-term success. As we continue our journey in financial accounting, we will explore one of the most important concepts, the accounting equation. Get ready for the good stuff in our next lesson, where we break down assets, liabilities, plus owner's equity, and see how it forms the backbone of financial statements.